The scramble for Africa and its still largely untapped resources and wealth continues to this day, though the push may change in intensity and tactics through different eras. According to Tom Butler, Global Head of Mining at the International Finance Corporation, it is estimated that the current value of known subsoil assets per square meter in sub-Saharan Africa is around 1/4 of that in high-income countries. There is yet an enormous amount of wealth left yet to discover, and roughly $1 billion needed to put that geological information on the map. Despite the mouth-watering possibilities, those seeking to excavate their fortunes are faced with pessimism from the global financial crisis, low commodity prices, and other detractors that have limited investors' appetite and budgets. And it is in light of these tough times for resource companies that we here at First Issues decided to hear from a leading African corporate and investment bank the ways in which a resource company can best source funding for their projects. Welcome to the show. Botswana has huge deposits of diamonds, copper, coal, cobalt, gold, salt, nickel, and uranium, and the country's mining sector has continued to make the largest single contribution to the economy since a few years after independence. The country's current estimated coal deposit is 212 billion tons. It is the world's largest diamond producer by value and has a copper and nickel mine that has been going strong since 1974, with more copper discoveries and mines coming up. It is believed that over 700 prospecting licenses, covering over 2/3 of the country, have been distributed to hundreds of companies from all over the world. With the sector clearly being an important one to the country, the 2014 Botswana Resource Sector Conference, held at the Gaborone International Convention Center last week, was an unmissable event for both local and international stakeholders. However, the discovery of the resources alone, hundreds of meters beneath the sands of the Kalahari, is not enough. One of the key components of resource development, as with any other project, is funding. At the recently held Resource Sector Conference held in Gaborone, we discovered that this component is more complex than simply an entity going to ask for a loan from a bank. It requires experience, expertise, and knowledge depth from both the lending institution and the beneficiary. It was at this informative event that we sat down with Henk de Hoop, Business Development Director at Rand Merchant Bank, or RMB, Botswana, an institution with presence in the UK, India, China, and the Middle East that has funded several developments in more than 35 African countries over the past decade, to learn what the key considerations made when funding a project within the mining sector are. Good evening.
Good evening.
Could you unpack for us the key considerations that financial institutions deliberate on when funding a resource project?
There's actually quite a few, but banks like to control risk in particular. And mining projects in general are considered more risky projects. There's a lot of factors that can make a project go wrong, and as a result, a bank won't get paid back at money it's lent to the project. But in principle, we often start off with country risk, and in particular, Botswana ranks very highly in the sense of a good environment for mining investments. There is stability politically. There's also a very accommodating mining legislative regime. So as a result, projects in Botswana would be considered favorably from that aspect. It often is very important to have a project that is qualitative and ranks as one of the better projects out there. And that ranking of quality has a series of dynamics that can be the grade of the project, the size of the project, how low it will be on the cost curve when it gets into operation. Is it excessive capital, or is it reasonable amount of capital, so we have comfort that not only the bank but also the equity providers can actually provide money into that project. Then often very important for us is the management team. Is it a management team that has delivered projects before? It's no use if you have a fantastic project and actually the project doesn't get delivered because the management team is not capable of delivering it. So there's a list of probably 10, 15 factors that we would eventually consider as being very important for a project to be fundable and for a bank to be willing to lend them the money in view of the overall risk parameters that we have.
You focused quite a bit on the quantitative values, other than, of course, the country stability. Which other qualitative aspects would an institution consider?
Particularly what we've seen over the last few years is environmental issues becoming far more important for all the participants, be it the funders of the project from a banking side or the equity providers or governments, to look at the environmental aspects of projects. And environmental is very broad. It can be social, it can actually be project specific. And nowadays, most banks subscribe to what they call the Equator principles. That means that a project has to tick a range of requirements for a bank to even being able to lend money. It essentially becomes almost illegal to lend into a project that hasn't ticked all those particular aspects. If one looks at other qualitative aspects, we find that an environment where it becomes very difficult to get, say, logistic solutions in place, let alone the cost of the logistics. But if, for example, having the freedom to build a harbour or an agreement to build a harbour and a railway line is being made very difficult by government, you cannot bank a project. That has to be in place, it has to be locked in, it has to be funded separately often. But a very important aspect we find a lot of projects often is if the logistic solution does not work for that particular reason, we cannot fund and the project will basically die.
Our guest from RMB Botswana insists that they are a responsible lender and not only driven by profit. He says part of the considerations they make is whether a project will have a negative environmental impact on the area and the community in which they operate. And if this is so, they encourage prospective clients to come up with measures to mitigate any such negative impact before they can give their request for funding any further consideration.
I guess the history of mining doesn't matter where you've gone, be it the US, be it in Australia, has been that it's been considered almost a rape and pillage industry where you go in, get the metals out, and the shareholders get all the money, and at the end of it there's a dark hole left in the ground and the villages are none the better for it. Plus some environmental pollution that will last for the next 30 or 40 years after the mine has closed. Now, that is a very extreme case, what in fact is probably not true for a lot of mining projects, but nowadays it is before the mining project starts already necessary to lock in what the mine will look like at the end of the project, how it will be rehabilitated, what effluents are coming from the mine and how you will treat those. What will the benefits be for the community, for government, and for the employees around it? And what solutions have you got in place afterwards? And while you're operating there, what are you going to do about schooling in the villages? What are you going to do about broadening employment opportunities? And the idea of the Equator principles is to make sure that a mining project cannot almost start with bank funding if that isn't determined upfront, that we have good plans in place, that we know what we're doing to the environment and how we can avoid damage and rehabilitate where necessary. It's kind of made or more and more aligning with what companies themselves want to do, what governments want to do, and what the banks now require you to do as well. And in order of this industry to grow, it's absolutely essential. The environment has changed. One has to make sure that that is part of the package of getting a mine off the ground.
In the presentation you made, it appears that commodity types is also a factor to be considered. Are there some commodities that are more attractive to banking institutions? If so, why and why not?
Banks do not like commodities that are extremely volatile. It simply makes them very unpredictable in what cash flows will this project produce in the future that can pay us back. Shareholders often can handle a bit of volatility simply because they're in the mining sector, and that's one of the reasons they're in the mining sector, that volatility of the revenue line. Banks cannot handle that very well. If you can actually stabilize that through hedging, essentially securing a price upfront over the period of the loan, often 3 to 5 years to 7 years, it de-risks the projects and it makes the banks more comfortable. Now, not all commodities can be de-hedged. Chrome is particularly difficult to hedge. Copper is very easy to hedge. Gold is very easy to hedge. Iron ore used to be a bit more difficult. It's getting a little bit more easier as well, but not too long out. So depending on the commodity, it determines almost the attractiveness of the debt funding side of things. The more difficult ones that I can think of immediately is diamonds is often a little bit more difficult, simply because it's a market that is so difficult to understand. It's not a fixed revenue line. The price per carats are all over the show. The geological models are often a bit more difficult to understand, but it's getting easier and easier as you go into more fixed ore bodies, the kimberlites, where, for example, Botswana has a very strong presence. Alluvial diamond deposits are very difficult to fund for banks, for example. Uranium tends to be a bit tougher as well for in general to fund, and chrome projects are often quite difficult to fund as well from a bank's perspective.
Join us after the break as we continue our discussion with RMB representative Henk de Hoop on the funding considerations made with regards to companies within the resources sector. Welcome back to the show. As having told us what banks look at when funding companies within the resources sector, our guest now tells us the best practices when engaging a financial institution for such projects. How early on in the project should the overseers engage a financial institution for funding?
You have different stages in mining projects developments. The one stage is obviously exploration. That is a very high risk. You spend money on drilling, you might not find anything. And that's not money that you can source from the banks. Once you've built enough confidence in an ore body where you get to, say, a inferred indicated resource of sufficient size, that's important as well, it will give banks confidence that there is likely a project. We need qualitative measures to see the grades are right. It is not structurally complex. It still has upside to grow. It is of sufficient size. It is in a reasonable location. Then talking to banks could be a good start, but there's still a long way to go. Then at that stage, normally, you still have about 18 months to 2 years to go before you get to a bankable feasibility study. That period would be a good time to already start talking with banks. What are the options? What we can look at? But there will be nothing formal. In a sense, we can't commit to anything. It is only at the stage when a bankable feasibility study is pretty much complete, that's when the banks get seriously involved. We will normally technically relook at it separately, because we will have normally an independent technical company to actually relook at that bankable feasibility study to give us comfort that they haven't missed anything. And then the intensity of the interactions increases a lot, because now we have to also start looking at the overall funding package, and is this the right way it's being structured? The company then is often very intensely busy at the same time with doing all the final paperwork. It is, are the water licenses in place, or is the power supply in place? Have you got your mining licenses right? Is the environmental material all done and signed off on? So it becomes then a very intense phase and interaction. Companies then have choices. They can ask a bank to run this process for them, or they can do that independently, but it's often a competitive process. So several banks will bid for the options, and the companies, based on the different proposals, can then decide this is a structure that I like, because not all banks have exactly the same requirements, although the principles of a bank wants to go in with as little much risk as possible is still the same for all the banks.
Liberia, Africa's oldest republic, is best known for its vicious civil war that raged for all but 2 years between 1989 and 2003. More than 10 years later, the country's Nobel Peace Prize laureate president, Ellen Johnson Sirleaf, is struggling to rebuild the country quickly amid accusations of nepotism and questions over the legitimacy of forestry and palm oil concessions. The United Nations still maintains some 15,000 soldiers in the country, one of the organization's most expensive peacekeeping operations. Many of the country's roads are impassable in the rainy season, power is patchy and expensive, and only one of its railway lines has reopened since the war. At face value, one would assume the country would be a no-go area investment-wise. But Henk reveals that it takes an experienced financial institution to see beyond current challenges and identify and finance projects that can end up contributing positively to the development and stability of a country.
A very recent one was a Liberian gold mine. It is actually the first gold mine ever in Liberia. Liberia as a country is obviously one of the higher risk destinations, so it was, in principle, it would have been difficult to debt fund that. What helped that project? First, it was a quality project. It had high grade gold. It was open cast, so there's little technical risk. It is a commodity that one can hedge, so it de-risks us, which we spoke about earlier. It also had a supportive shareholder base, so they could get some of the equity money for that project while we supported them on the debt side in particular. What helped in particular is there are several countries have, when you buy their equipment, in a sense of their manufacturers' equipment, they were willing to de-risk that project by providing a sort of insurance. And in South Africa that's called ECIC, but many countries have different schemes. In a way, South African projects often end up using a lot of South African equipment because it's cost competitive and it has a long history of producing mining equipment for projects. And as long as a project in Africa has 50% South African content, you can actually apply for that ECIC insurance. It drops the cost of the debt, and as a result, the equity returns actually can increase, and it helps projects to get off the ground, and it helps South African banks to fund competitively. Now, all those boxes were ticked for this particular project, and as a result, it became a fundable project that at first sight, first ever gold mine in Liberia, looked very difficult, but it managed to get it past the line based on all those factors having been ticked.
Well, it's been a year since RMB has been here in Botswana. What opportunities have been identified here? Where are we at?
I guess Botswana's focus in broadening the mining footprint away from diamonds only, or the big diamond cash producers that the country has, into coal, base metals, smaller diamond projects, uranium, iron ore, makes a lot of sense. The hard work is being done there. A lot of the exploration money is being spent, and a lot of good stuff has been found. It is not without its challenges, and particularly in the base metal side, prices aren't as great anymore as what they were. Copper has fortunately held up reasonably well. Nickel has gone through some very wild swings, making it quite difficult to build nickel projects simply because of that volatility in the top line. The coal sector and the iron ore sector, obviously, like any bulk commodity, completely depend on either a local market or an export solution. And yeah, the big opportunity, but also the big question for Botswana is look, how do we get this resource monetized, and how do we get that material out of the country into an export market? It is tough because coal prices have been under pressure like many commodities. There's a lot of greenhouse gas pressure on maybe moving away from coal power stations, but the basics are still there that power demand in the world will grow. Coal will be a strong pillar of that, and there will be growth in coal demand, and particularly the Indian market remains very attractive because it will look at significant imports in the years ahead. The capital hurdle is obviously very large in the case of where the Botswana coal deposits are. We either go west, we have 1,500 kilometers of railway line to build, or we go east, and then we have to deal with several countries that are all having coal deposits that want to go out as well, and one sits in the back of the queue. There's good news from South Africa that Transnet, we see a lot of positive developments happening in the railway capacity growth, also from the Waterberg. We're seeing a lot of actions on the ground. Locomotive orders have been put in. A lot of the volume growth is being achieved on the manganese lines, the iron ore lines, the coal lines as well. So I think that it is a regional issue that's being slowly but surely resolved, but it will take time and still lots of money potential to make it work.
It is now time for the stock market review, courtesy of the Botswana Stock Exchange.
A very good evening to you all. Let's have a look at last week's capital market figures. We start with the DCI, Domestic Company Index, which was up 0.14%, whilst the Foreign Company Index, FCI, was up by a fairly similar amount of 0.13%. Total turnover for the week was 22.5 million pula, a daily average of 4.5 million pula, and the total number of shares traded for the week was 2.3 million. For the year 2014 so far, the DCI is up 0.79% compared to a 15.7% increase at this point last year. The Foreign Company Index, FCI, is up 0.29% compared to a decline of 1.15% at this point last year. If you look at turnover, total turnover for 2014 has surpassed the billion pula mark and stands at 1.01 billion pula compared to 810 million pula at this point last year. And the total number of shares traded for 2014 is 289.9 million compared to 275.9 million shares last year. If you look at our exchange-traded funds, both the Better Beta ETF and the New Gold ETF rose 10 thebe to end the week at 42 pula 35 thebe and 105 pula 80 thebe respectively. Thank you very much, and may the rest of your week be very productive.
For a recap of this or any other First Issues episode, feel free to visit both our YouTube and our Facebook sites. From me, Nameto Sibina, the team behind First Issues, and our sponsors First National Bank, we wish you a good night and pleasant viewing.